the other thing about the adjusted EBITDA number is that it helps capture not just the top line growth, but also captures margin improvements at the gross profit line, as well as whether there's operating scale that's kicking in, right? And so we know that if we just look at the revenue CAGR has been about 50% over the last 6 years. And the EBITDA CAGR has been about 67%. So when you see EBITDA outpacing revenue growth, that means that there is operating scale that's kicking in. And that's exactly what we need to see in order for net income at the GAAP line to flip positive. So this is going to happen first, and then GAAP net income is going to happen afterwards. So as long as we see this trend continue, where we see, you know, the adjusted EBITDA line increasing, going up into the right, that is the leading indicator for GAAP net income to flip positive again. So, and we saw this, you know, with Amazon, you know, from 1996 to 2003. There's a period of 7 years where they produced, you know, GAAP losses the entire time for 7 straight years, but their EBITDA was growing at during that entire time. So EBITDA for any capital intensive business is going to flip first. And as long as it continues to grow, that will ultimately reflect in the GAAP net income line. So I think that as long as we see a growth in EBITDA further, and as long as it outpaces revenue growth, which it has been, we will see GAAP net income flip and go to the positive, you know, back into the black.
Yeah. And just before we move into this cash flow piece, what basically the difference in that adjusted EBITDA line and the GAAP income is all of these additional non-cash expenses and then business expenses that aren't necessarily tied to the core business, maybe interest on loans. So you're not saying that it doesn't matter that they're losing income on a net GAAP income basis. Just when you read in between the lines, you can kind of see why. And there's a lot of reasons of why, like there's silver linings, and we can see that this is improving and has a path to improvement. But so like why are you not, I guess, like diving into the GAAP net income? Because it's like the worst looking chart. So I want to kind of like give that time. Like, why does that not bother you? And how do you expect Tesla's GAAP net income to kind of trend? Is it going to stay sort of negative around break even for like a long time? I think that's what Elon's guided, at least until robo-taxis really hit, because just like Amazon, growth mode.
Mm-hmm. Yeah, I mean, obviously net income GAAP is important, right? It's the ultimate measure of profitability. It's the strictest measure of profitability. However, like I said before, the job of an analyst when looking at any company is to ask why, right? Why is GAAP net income positive, or why is it negative? Some people can achieve high net income on a GAAP basis by simply restricting CapEx. They can achieve positive net income by restricting R&D, right? And we see that happening now with companies across the board where, you know, they're cutting CapEx, they're cutting R&D, they're cutting everything that's not needed to be able to survive this crisis, right? So, you know, yeah, they could achieve GAAP net income, but is that really what we want to see, you know, for companies? So, you know, Tesla could achieve, I think they could achieve GAAP net income if they simply stuck to making the Model S and X, right? If they just did Model S and X, they focused on selling $100,000 cars or $120,000 cars and did not invest in, you know, high scale production and international growth and expansion. You know, I think they could be like the Lululemon of the auto industry. They could be like another Ferrari. However, that's not the vision of the company, right? The vision is to achieve, advance the, entire movement towards sustainable energy.
Right.
So GAAP net income, I think, is important to consider, but I don't think it's the number that we should be really focused on as much. In my opinion, I think free cash flow is the much better measure of profitability than net income, because at least that number looks at whether the company is burning cash or generating cash. And ultimately, cash is the more important number rather than accruals, because everything on the income statement is on an accrual basis, right? Income and expenses are recorded when they are accrued. Whereas the cash flow statement looks at how much cash is leaving the business and how much is entering, the business. So in my opinion, and a lot of investors actually, a lot of, big time investors agree with this general statement, not specifically on Tesla, but just in general, that free cash flow is a better measure of the health of a company than GAAP net income.
Yeah, because you can't play games with it. It's like, did your cash in your bank account go up or down? Usually, barring some crazy situations, that's a pretty good sign of how your business is doing, and very hard to misguide someone. But at a high level, I think, just to sum up before we dive deep into this cash flow point, there's a company behind every stock. Tesla's not trying to maximize profitability right now. And if they wanted to, the company would look totally different. They're trying to grow and get way, way bigger. And that's why the financials look like the way they do right now. It's not like they're struggling to make money and they can't. It's like they're literally moving 1,000% in investment mode pretty much at all times, like a la Amazon, which is a totally crazy way of how companies have never really been run before until Jeff Bezos and Elon Musk. So I want to get to that at the end of this. But with that, let's talk about the actual cash flow generation of Tesla's business, because this is where the rubber meets the road. And this is what every single bear short this is the chart to me of why Tesla stock has gone to new highs. This is why the short thesis actually crumbled, because what they said Tesla could not do was actually make money. And the second 4 or 5 quarters ago, they're printing 400 million in the bank, 500 million in the bank, just like you're saying. Cash flow. It's pretty hard to say Tesla loses money on every car sold when they keep adding hundreds of millions to their bank account every quarter, selling tens of thousands of cars, right? Yep. So, so with that, let's dive into, you got operating cash flow. We can start with that.
Yeah, so this is, I think it's very, very related to the adjusted EBITDA number, because the only difference between operating cash flow and adjusted EBITDA is the cash flow statement starts with GAAP net income and then starts to add back all the non-cash expenses. So this number is going to correlate very closely with the adjusted EBITDA number that we just looked at. So in my opinion, I think the operating cash flow number is the most important, metric to look at Tesla's growth, from a bottom line standpoint, that is. The top line obviously is important with, revenue growth, basically telling us how strong demand is for these products. But the cash flow number, in my opinion, is sort of the number that we should be looking at when assessing their profitability. Now, it's not profit, it's cash flow, right? So those are two sort of technical terms that you have to distinguish between. But if you want to know, in my opinion, the operating cash flow line is the number to watch to understand how much is Tesla actually bringing home, in the bank, right? The free cash flow number looks at operating cash flow minus CapEx. So that's the net number that's being added to their bank account. But I would look at this number too, and as long as it's above 0, that's basically my minimum requirement, because as long as they're not burning cash like they used to, you can see that number has flipped pretty decisively now, where we've got 3 quarters in a row that we've seen trailing, 4 quarters of free cash flow being positive. And it's almost at, it reached almost $1 billion at one point. Now, I'm actually using a slightly different definition of free cash flow here, which is that I take the operating cash flow minus CapEx, and I also subtract out the finance lease payments that they've made. So this is important because a lot of what they've done at Gigafactory 3 in Shanghai is they've arranged the acquisition of a lot of those tools under a finance lease sort of arrangement. And a finance lease is basically just like, the simplest example is like a mortgage, right? If you buy a house on mortgage, you pay in, monthly installments, and over time you build equity into your house, but you get to keep the ownership of the house and you get to own it over time. So in the same way, a finance lease is basically, when Tesla acquires tooling and, parts of the factory and other things like that, under a seller provided financing. So over time, they have to acquire it. Basically, they get it all up front. but they recognize these payments over time. So that's technically also CapEx. So I sort of add that back as well. And even after that, Tesla is positive on free cash flow. So that to me is the most important trend shift that we have seen through the entire history of Tesla, where for years and years, right, they burned cash. They not only were net income negative, but they were also burning cash. So that's not sustainable. So they were dependent on the capital markets to be able to finance that entire thing. Now they're not dependent on capital markets anymore. And I know that they just raised, $2.3 billion in equity just a few months ago. But if this number continues the way it is, that's going to be just essentially a safeguard or sort of a rainy day fund or something like that, because they just did $750 million last year in 2019, according to this metric.
Right.
Cash flow.
And if you think about this, is like, to me, the biggest milestone in Tesla's history. We have an asset, this crazy electric car company that is burning, billions. It looks like the product's awesome. It looks like it has all this potential, but like the financials, because they're so vertically integrated, it's so capital intensive. And people will say Amazon got profitable faster, Amazon's CapEx was less. I think Tesla's way more capital intensive per dollar of revenue than Amazon. So you have to look through that lens. And we finally, like even way more than I would have expected 2 years ago, like we've truly seen that dip to like, this is an asset that pumps out cash. And I think that, and like you said, they don't rely on the capital markets. This is why Jim Chanos's entire thesis is wrong. You have to keep raising money. Well, now Tesla doesn't. They can use that cash from their core business to fund it. They're no longer reliant on this perceived solvency thesis where the stock market has to believe they'll succeed to keep giving them money. It doesn't matter because they can get money there on their own. And I think this single-handedly stopping being reliant on the capital markets is why the stock has gone up. Like, you can't take this down with fear and trying to freak the market out, because it doesn't matter, because Tesla's not relying on that as much anymore. So I think this is like, this chart is truly the evidence of the biggest transformation Tesla's business, sort of a growing up, maturing phase to like becoming a grown up almost.
Exactly. Yeah.
And actually, sorry, I forgot to add on that. Amazon, the first thing they say in their earnings releases is operating cash flow is this, and then CapEx is this. These are before they're talking about earnings, if you go read their press releases. So I think when we're talking about these rapidly growing companies that are managing the profitable operations with cash coming in and immediately reinvesting it into these new things, this is almost slowly becoming one of the new most important metrics in finance for these new sort of hyper change, rapidly growing firms.
I would 100% agree with that. I think free cash flow is the ultimate measure of whether the company is sustainable or not. So if free cash flow is negative, that means that the company is reliant on debt and equity markets. If free cash flow is positive, they're not reliant on debt and equity markets.